I think that this rate cut and the fact that we're getting two more at a minimum between now and the end of the year, that I think ensures smooth sailing for new record highs. I still think we have a good shot at hitting $4,000 gold by the end of the year and $50 silver. So right now you still got quite a bit of upside in both, especially silver is now back below 42. So you got about a 20% gain between here and $50. That's not bad. Now, of course, I don't think silver is going to stop at $50. I think it's going much higher, but it may not get much higher this year. So I think by the end of the year, that's a realistic target.
As noted by Morgan Stanley, silver's lower price point makes it easier for investors to adjust positions based on market conditions, providing greater flexibility in portfolio management. Gold has already surpassed its all-time highs and continues breaking records. Silver, on the other hand, is still trading significantly below its 2011 peak of $50. Many investors see this as a signal that silver may have more room to run in the current bull market. The recent volatility in gold and silver is just a shakeout before the real rally. Financial advisor and expert Peter Schiff predicts gold could hit $4,000 and silver $50 by year-end, with silver offering particularly strong upside. Schiff also notes that gold mining stocks are showing powerful chart patterns, signaling they are poised to benefit from this coming surge. From a technical perspective, Peter Schiff says the Fed's next move is its biggest mistake yet. While rate cuts will push gold and silver even higher, they will not solve the inflation crisis. Schiff warns that bonds will be the ultimate victim, as their yields offer no protection against an inflation rate that is well above 2% and rising. Goldman Sachs' chief macroeconomic researcher has warned that the current market dynamics are being driven by a narrative of liquidity, with the dollar's decline mirroring patterns from the 1970s. This situation raises concerns about a potential repeat of the 1979 scenario, where the collapse of long-term bond markets could force policymakers to confront systemic vulnerabilities. A key structural signal is the first instance in 3 decades where foreign central banks hold more gold than U.S. Treasury bonds. Before we dive into Peter Schiff's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
I think we touched 3,700, but it was a roller coaster ride. You know, silver was down almost $2. Like there was a big sell-off. Silver almost got to 43 yesterday. And before the open, there was just, I think they really rushed a lot of the stops and they had a big drop in silver, almost $2. And a gold was down like 30 bucks, 40 bucks. But then it was up like 30 bucks after the news came out. So it went on a roller coaster ride, but it only closed down about, I don't know, $20, $30. So gold's around 36.60. I mean, not too far below the record high. There were quite a few gold stocks, that closed positive on the day. They were down quite a bit yesterday, even though there was just a small move down. But I think that this rate cut and the fact that we're getting two more at a minimum between now and the end of the year, that I think ensures smooth sailing for new record highs. I still think we have a good shot at hitting $4,000 gold by the end of the year and $50 silver. So right now you still got quite a bit of upside in both. Especially silver is now back below 42. So you got about a 20% gain between here and $50. That's not bad. Now, of course, I don't think silver is going to stop at $50. I think it's going much higher, but it may not get much higher this year. So I think by the end of the year, that's a realistic target for silver. So I would buy it now, shiftgold.com, right? We don't just sell gold. We sell gold and silver, but the mining stock charts look even better to me. The GDXJ hit a new, I think, record high. It finally took out its high from 2011, but the GDX, which has been acting stronger of late, still needs to rise about 60% from here, I think, to get back to its 2011 high. But based on the chart, it looks like it's going to go there very quickly. So I would be buying these stocks as quickly as I can. My favorite way to participate is my own gold fund, the Euro Pacific Gold Fund. EPGIX is the no-load symbol. You could pick that up anywhere. And I'm not just saying you should buy gold stocks or my fund because I make some money. Of course, I don't make any money if you just buy gold stocks at some random discount broker. But I'm happy regardless. But I think our fund has a lot to offer, and I think we're going to outperform over the long term. But the real reason I want my audience to buy them is because I think you're going to make a lot of money if you do. It's not that there's no downside risk. There is, but I think it's minimal when you compare it to the upside potential, which I think is enormous. And unlike the Fed, I have a lot of confidence in my forecast. I'm very sure that I'm right. I don't guarantee that I'm right, but I think I am. The Fed has no clue, right? But my forecast is not just a guess. It's based on my understanding of monetary and fiscal policy that apparently is lacking at the Fed. But we did have a bit of an up move in interest rates on the long end. The 30-year closed a little higher on the day, and that's been my forecast. The 10-year is 4.09. A couple of days ago, it was down to like 402, 403. I think we're headed higher from here. Right? I don't think the long end of the bond market is going to react positively to the Fed cutting interest rates when inflation is not only well above 2%, but headed in the opposite direction. The stock market, again, hit record highs. I think the Dow Jones hit a record high today, and it closed in record territory above 46,000. Dow was up 260 points today. The NASDAQ was actually a little bit lower on the day, as was the S&P. Neither hit record highs. It was just the Dow. Russell 2000, not a record high, but also up on the day. But overall, the stock market likes the news that the Fed is cutting interest rates. But I can assure everybody that this is a major policy mistake. This is going to go down, I think, maybe as the biggest mistake. And that's saying a lot because they've made so many big mistakes, like the ones that led to the 2008 financial crisis, inflating that housing bubble, and the mistakes over COVID that led to the transient inflation that wasn't transient. So they've made a lot of mistakes cutting rates, and this could be the worst one because inflation is headed much, much higher, and they've already put themselves on a preset course to cut rates, and they're not going to change from this course because they know what it might mean to the market. So they're going to have to rationalize all the upticks in inflation and attribute it to the one-off effects of tariffs. They probably don't want to say transitory, so I guess they'll come up with another word that means transitory, like with abundant and ample, maybe, not transitory, transient or temporary. I don't know, whatever. They'll come up with a synonym that means the same thing, but doesn't quite subject them to the same degree of ridicule. But you got to look through all that, and you got to load up on inflation hedges. All your investments, I think, should be non-U.S. dollar. The dollar's got a one-way ticket down. You don't want to go down with that ship. You want to abandon ship, and you want to buy foreign stocks that continue to eat the lunch of the U.S. stock market year to date, despite the fact that it's hitting nominal record highs.
There is no doubt that the Fed is a puppet show. Peter Schiff argues that the supposed disagreements within the FOMC are meaningless because all members ultimately want more inflation and lower interest rates. Their forecasts are worthless, and their promise of 2% inflation is just wishful thinking. As Jerome Powell himself admitted, they have no idea what will happen. At Wednesday's meeting, the Fed lowered its policy rate by 25 basis points to a range of 4% to 4.25%, its first cut since December, and signaled a gradual easing cycle in response to mounting labor market concerns. At the same time, Fed Chair Jerome Powell highlighted a challenging situation for policymakers, noting that risks to inflation were tilted to the upside and employment risks were tilted to the downside. Investors appear poised for a volatile few months ahead, following the Federal Reserve's decision to resume interest rate cuts and open the door to further easing, albeit tempered by warnings of sticky inflation, which sows doubt over the pace of future policy adjustments. The Fed's actions are political, not economic. According to Peter Schiff, the central bank is deliberately propping up the economy while redefining price stability as perpetual inflation. This exposes its dangerous willingness to sacrifice the dollar's value and its own credibility to maintain appearances. Let's get back to the interview.
Another interesting discussion had to do with the widespread views, apparently. I don't think their views are that widespread, right? If some people want 25 basis points and some people want 50 basis points, to me, there's not that much of a difference there. I mean, if some people wanted 50 basis point hikes, fine, right? If you had a Peter Schiff on the FOMC, yes, maybe you'd have a divergence of opinion. But as far as I'm concerned, they're all on the same page. They all want more inflation. They all want to cut rates. It's just a question of how much and how soon. So I don't see that as a vast divergence of opinion that Powell is discussing that apparently there is at the Fed. They seem pretty uniform to me. But he said that he's not surprised by this because nobody really knows what's going to happen, which is one of the few honest things that he says. Yes, they don't have a goddamn clue what's going to happen. So what's the point of having an FOMC if they really don't know what's going to happen, right? We don't need them. And we certainly don't need to have a press conference where they can make forecasts that they have absolutely no confidence in. In fact, he was asked about his forecasts, and he said that they normally don't have much confidence in their forecasts, and particularly now, given all the extra uncertainty that we supposedly have now, he said he doesn't even know any forecasters who have any confidence in their forecasts. Now, what is the point, right, of having a forecaster if they have no confidence in what they're forecasting, right? I mean, would that be like the weatherman, and he gives a weather report and he says, well, it may rain, it may not. I really have no clue. I have no confidence in this forecast. Well, then what's the point of the forecast? If you can't have some kind of degree of confidence, yeah, it's going to rain, right? Because people, they plan their days around these forecasts. Like, should I have a picnic? Oh, no, it's going to rain. I bet if the weatherman says, well, what the hell? I mean, it might be sunny. I really don't know. I mean, well, what are you going to do? And so it's for Powell to say this. In fact, there's an old joke that God created economists to make weathermen look good because, the weathermen don't always get it right. Well, the economists never get it right, especially the ones at the Fed. But now Powell actually admitted that they have no confidence, which brings me probably to the most startling admission of the entire press conference, right? I put something about X. I don't know if anybody else is going to pick up on this the way I did. But somebody pointed out that the Fed has a forecast, which is that inflation will be 2% in 2 years, right? Now, right now, it's in the mid threes, right? No, so it's not even close to 2. But the forecast is that 2 years from now, we'll have 2% inflation. Now, of course, we haven't had 2% inflation now in like 5 years, right? The last time we had something close to 2 was 2000. So we've had 2001, 2, 3, 4, 5. So 5 years of above 2% inflation. And now we're going to have 2 more, right? So now 7 years above target. Now you would think we've been above target for so many years. Why is the Fed cutting rates? Does the target not mean anything? Clearly, whatever they're doing ain't working, right? I mean, why aren't they being as aggressive to get inflation back down to 2% as they were to get it up to 2% when they were doing quantitative easing like crazy at 0% interest rates, right? It was a real emergency to get 1.5% inflation to 2%, but to get 3.5% to 2%, not only is it not an emergency, we'll just cut some rates, right? But so the question was, you have a 2-year forecast that inflation is going to be 2%, but the reporter said 2 years ago you had the same forecast. So 2 years ago you said we'd have 2% inflation in 2 years, and we don't. And now you're saying that we'll have 2% inflation in 2 years. So will we? I mean, how confident are you that you're going to hit it this time? And he basically let the cat out of the bag and said, we don't know. He basically said, look, our goal is 2% inflation. And so that's our forecast. We make a forecast that's consistent with our goal. So in other words, it's just wishful thinking. He says, look, we asked the FOMC to come up with policies that they expect will result in 2% inflation in 2 years. So the idea, the forecast of 2% inflation in 2 years is not based on any actual forecast. There's no methodology, there's no statistics or any kind of regression or anything that gets them to 2%. They only forecast 2% because that's their target. Their target is 2% inflation. So they just had to come up with a time frame. Okay, we're above our target. What is the time frame that we're going to use for our forecast? And from any point in time, it's always 2 years. So no matter when you talk to the FOMC, they're going to have a forecast of 2% inflation in 2 years. Now, why 2 years? Well, because if it was 6 months, maybe that's too short, right? And it'd be too obvious that they didn't have the target. Maybe they like the symmetry. 2 and 2. That's their rallying cry, right? Remember, it was like the 15 hour minimum wage, whatever that was. I forget. Was it 15 for 15? I forget. But it's 2 for 2. Right? Yeah, right. That's their mantra. Right? Means absolutely nothing. So this should be an admission to everybody to take their forecasts with a huge, not a grain, like a massive ball of salt. It's meaningless. And so if the Fed has no idea where inflation is going to be in 2 years, but they know where it is right now, what business do they have in cutting interest rates? As far as they know, it's going to be 5% in 2 years. They're clueless, right? So this is all political. They're trying to prop up the economy. They're trying to deal with the third mandate that they didn't even admit they had, right? Because somebody asked a pal today about the so-called third mandate that is being discussed in Congress or the Trump administration. Remember, the two mandates that the Fed acknowledges are price stability and full employment. Now, price stability has been redefined as prices that go up every year by 2%, which is no longer stability. Stable means unchanged. So price stability would be the prices we had last year, they're the same as this year. That's stable. So why doesn't the Fed change its goal from price stability to prices that go up by 2% every year, right? Ever increasing prices, right? And in fact, it's not 2% because it's much higher than 2% and they're not doing anything about it. In fact, they're cutting rates.
In an economic world shaped by rising debt, global uncertainty, and persistent inflation, precious metals are proving to be a trusted anchor for investors. And when it comes to silver versus gold, the debate is more relevant than ever. As noted by CBS News, silver's smaller market size means that when investment demand increases, the price impact can be much more dramatic than with gold, potentially leading to higher percentage returns during bull markets. Will the Fed's policies finally prompt investors and foreign governments to shift their holdings from U.S. Treasuries to gold and silver? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.